Welcome to another edition of the Wealth Multiplier podcast for incorporated Canadians. My name is Laurent Meunier from Safe Pacific Financial, and today we're talking with Damon Steele from Pilot Mortgage. We're going to be talking all things mortgage, especially as it relates to incorporated professionals, incorporated business owners in Canada. They've been doing it for a really long time for thousands of clients, and they are boots on the ground seeing every day what is happening for real in the mortgage landscape. So we're going to cut through a lot of the BS that you might be seeing on TV and tell you really what is happening every day to real people. I'm going to introduce Damon a little bit. He's a partner at Pilot, one of the owners there, but he's going to tell you his full, how great he is and why he's here.
Thanks, Rod. Yeah, so I'm coming up on my 14th year in the mortgage broker industry, and prior to that, was working as a financial planner. So with a financial planner background, it was kind of in the heart of 2008, and so when you were, in your early 20s, trying to become a financial planner in the global financial crisis, tough to find your footing, but had the benefit of working with some great mentors that suggested maybe I should go into the business development side of the mortgage biz. And that's where I got my first taste of the mortgage industry and working with high caliber mortgage professionals, mortgage brokers that were referring to the company I was working for at the time for lending. And eventually, 14 years ago, joined that team. About 7 years ago, myself and another partner bought the original founders of that business out. So we've been basically there for the entire duration of my mortgage broker career. And one of the blessings that we had in having worked with such a strong, high-producing team was visibility in the financial planning world. So we, in tandem with working with realtors and other clients, one of the mainstays of our business is working with financial advisors, financial planners, wealth advisors. Assisting their clients who in many cases are incorporated professionals, business owners, medical professionals, who may have more complex, comprehensive income structuring. And income is, by and large, probably the most important factor when it comes to getting a mortgage today in Canada. So great visibility in how to be able to get some of these really tough deals done with a real distinct focus on assisting those types of clients.
Perfect. That's a great intro. So Pilot Mortgage is only a few years old, but the roots of it, like you guys are coming up on probably almost 40 years.
Yeah. So we rebranded as part of our purchase of the company. So Pilot Mortgage Group in itself, or as it's named, has been about 8 years now. So we're kind of, we've got some time on it, but the company, and it's with the pre-existing founder, I think we're coming up on 40 years altogether.
Nice. So let's just jump straight into it. You were talking about your experience working with incorporated people, and especially when it comes to like looking at it from a financial planning type of lens. I know that a lot of our clients are incorporated. They either own their business or they're some sort of professional and they're allowed to be incorporated. And then the way that you structure your income there, you're not usually getting a lot of T4 income, which is what a bank wants to see. And they might have very low income on this side, but very high income on that side. How should an incorporated person approach getting a mortgage? How early do they need to start? How do they need to structure their income? Does every mortgage broker know how to deal with that type of income? So yeah, let's start with how soon should they get started? Should they show up and say, I need a mortgage tomorrow, or is there some planning that needs to go around?
Yeah, the sooner the better. If we can prepare ourselves and work with their professional party. So for instance, working with their financial advisor, working with their accountant, to make sure that we're setting things up in such a way that it's going to allow them or empower them to qualify for the financing that they're going to need at some point in time into the future without compromising, tax efficiency that their accountant planning to try and build into their existing personal taxes or for their corporate taxes. So what we'll often find is that accountants, they're mandate, their goal is to reduce your tax liability. That's it. And as long as they're accomplishing that, then they're doing a great job. But what that can sometimes get in the way of is the mortgage planning. Lenders are looking to see, to some extent, personal income to be able to help with qualification. One of the things that's kind of changing now, it's improving for the incorporated individual, is a better inclusion by some institutions, not all, but by some banks, credit unions, to also include things like proportion of your net income from your corporate net income from your corporate income after taxes, for instance, exclusive of dividends. It's important for us to be able to have a conversation with the accountant to prepare them for, okay, how can we work with this individual? They have a plan to then likely purchase a property in the next 2 years for up to $3 million.
Yeah.
We need to be able to claim a personal income of at least this. They can also, that personal income can be a combination of either T4 income, but also T5 income from dividends. Cannot factor in capital gains. So for instance, if some people are using tax strategies that are more inclusive of capital gains as being an income generation, in many cases that's not used by most Canadian lenders as income. But we can work within that, and we can also look at net income so long as the shareholders of the company are the ones that are the mortgage holders. So for instance, if you co-own a corporation with a number of other stakeholders and it's only yourself that's going on the mortgage, that's going to be more of a challenge, as opposed to if it's your personal holding company that owns the shares in that operating company and then draws down a tax-free dividend, that we can use.
Right.
So you can understand why it would be important to start preparing in advance, being able to actually have that type of income put in place so that if we've structured it appropriately, we can actually use corporate income in their application and qualify them for the property that they're looking for at the best terms.
Right. Okay, cool. So yeah, a lot of the times when we're working with people as well, we want to see that kind of operating company, holding company structure, potentially a trust. And so, yeah, if you don't have that set up yet, then you'd want to, have that done before you go and apply for the mortgage. And that can take a little bit of time if you need to restructure or if you need to, you get your paperwork done. How much time, so say somebody has that already set up, what would be like an ideal amount of time before they want that mortgage to fund that they should start talking to somebody like you?
As long as we can have visibility on what it is. They may be able to qualify for whatever they want with whoever they want now.
Right.
It may not necessarily be that linear. So it may be with, let's say, for instance, 2 lenders out of a possible, 15, between the big 5, between credit unions, whoever it may be. Maybe there's only a few outlying lenders that would be willing to consider it based on the constraints of their application.
Right.
So we, by initially having visibility on it to start off with, we can prepare them for, we only have 2 options that we could recommend at this time. With more prep and being able to, let's say, for instance, claim a higher income or being able to structure your documentation in such a way, in the next year, we could actually have a more robust pool of lenders to choose from.
Okay, cool. So it sounds like, if you're incorporated, ideally make sure your structure is set up properly and talk to somebody before you think you need it, just to make sure that when you go to get that mortgage, that things work out the way that you want.
I think one key element that we see quite often, and this could be from clients that are, I have everything with my RBC, banker or the private banking service that I offer. So, and they feel as though maybe they've approached them at some point and they said, you're capped at a certain loan amount. And they just kind of leave it at that because, they're like, they have all my banking, why wouldn't they be the ones to then offer me the highest loan amounts or to be able to offer me best terms? And that's where we'll often find the constraints, because they will eventually come to us because maybe they've been referred to us through their realtor who suggests maybe speak to them, maybe they can increase it and bolster it. And often clients are coming away surprised by how much higher they can get in terms of the total loan amount, depending on a lender that may not necessarily be who they have all their banking with. So policies play a huge role in lending outlook from different lenders as well. So I'm biased in this, but having somebody with visibility on the entire marketplace, like a mortgage broker, is only to your benefit because they can bring to your attention certain lenders that you may not have even thought of.
Right. Or you might not even know they exist.
Right.
Yeah. We find that a lot too in the financial planning world, in the insurance world, in the investment world, is that for some reason people have a tremendous amount of trust and loyalty to a bank that maybe doesn't have a huge amount of loyalty back to them, and maybe doesn't always show them all of the options because they try to keep you in the bank, and they're definitely not going to show you what's going on across the street.
Yeah.
Or even down the block.
One thing we hear a lot from our clients is they've come to us and they say, well, I do everything with my bank and they've offered me this, but they also mentioned if I can get a better deal to bring it to their attention because they can probably match it.
Right.
And I'm like, so do you want me to do that? Do you want me to provide you with something that you can then take to them? It's like, don't you feel like there's maybe kind of misalignment and value there for why aren't they providing you with the best available terms? They know what we're offering. It's not like your major bank is unaware of what's available in the marketplace. Those are their competitors. Of course they're keenly aware, but they want you to do the legwork to try and find it.
Right.
So if people find themselves in that situation, obviously we're happy to pass along and espouse our value to them, but just think a little bit about, well, why am I having to do the work for my bank to stay with them?
Yeah, you said you offer me the best rate, but if I can go find a better one, you'll match it. So you probably know there is a better one. Why don't you just match it now because you know it's there?
Right.
But, okay. Switching gears a little bit, not to people getting mortgages, maybe people who already have mortgages, especially if they've been set up in the last few years. They probably were set up at a lower rate, and today we have higher interest rates. The news is trying to scare everybody about these high interest rates as doom and gloom and everything is collapsing and blah, blah, blah. What is the reality in there? Like, what are you seeing? Like, you're dealing with hundreds of people all the time. And, if mortgages are 5 year on average, that would mean that every year, 20% of those would be coming up for renewal. So if somebody had a mortgage from a couple of years ago, 1 out of 5 is coming up every year.
Right.
What are those people like? What are their worries? Are those worries founded? And what are some solutions that we can work around?
Well, what's interesting is that just based on the nature of timing between mortgages that were taken in 2019, which would have been 5 years ago, plus how many people over the course of COVID took shorter terms than were typically taken, we're almost in the 80% in the next 3 years. Canadian mortgages are coming up for renewal. So it is the quote unquote
would be 60
wave, which would be 60. The average, the quote unquote wave of mortgage renewals that are coming up is in fact the case. What we are finding is that so many clients are reaching out to us. I probably field about 30 to 40 calls a week on just existing clients who have existing mortgages that are coming up for renewal, not like right now, but like are coming up in the next year to 2 years. And so they might be in a mortgage term. Rate was fantastic at the time, that's 2.35 or 2%. In some cases, we had with loans with rates as low as like 1.5%.
Wow.
As a fixed term. And, these clients are not necessarily like, oh, this is really great. They're actually really concerned about what does this mean for my upcoming mortgage renewal? And it's because the idea of what those payments could look like in the future is so abstract. And obviously, because of everything that they hear in the news, it makes them think like, are my payments going to go up 3 times, 4 times? Like it's this hard to understand number, and they haven't been able to do it. And it's really hard if they haven't spoken with their existing bank to really figure that out. So we reach out to all of our clients to prepare them for what to expect. And the conversation is actually usually really good. It's, okay, I can't tell you what it's going to look like in 2 years, but I can tell you approximately what you'll have outstanding in 2 years, right? Because we can estimate what you'll have based on
your payments,
what you're going to be paying down. So by the time that this is over and done, and thankfully because you had such a low rate to begin with, your mortgage balance is going to be reduced. So assuming you don't change the amortization, that's the length of time that you fully repay your mortgage, kind of which dictates your payments. And let's assume interest rates remain where they are today. Even though there's an expectation for them to decline, we don't have a crystal ball yet. So it's unfair for me to say they're going to drop by 1% or 2% or whatever it may be.
Yeah.
let's just assume worst case scenario, your outstanding balance, your existing amortization, and your interest rate, your payment is this. And 99% of people are like, oh, that's not so bad.
Right.
And then you go, well, what if we extend the amortization, right? You're contractually obligated or allowed to do this. And so your contractual obligation will be much lower by extending the amortization out. So your payments could be reduced to this. Oh, that's pretty good. I'm like, and let's say we do see interest rates decline by 0.5%. It could be this. So we immediately see a significant relief from clients when we have those conversations with them, because they know that it's not going to be as daunting or concerning for them in the next year or 2 years when their renewals come up. So we're encouraging anybody who wants to know what that could look like to reach out.
Right. So, yeah, that's definitely the opposite of what my social media feed says, where everything is on fire and everything is a disaster and the whole thing is going to collapse. But I guess that gets more clicks than, hey, things are probably going to be fine. Yeah, doesn't get a lot of clicks.
Yeah. Like, it's not to say that people's payments won't go up.
Right.
They will go up by virtue of interest rates having risen. But what people assume it's going to go up by is nowhere near what the reality of it will be.
Mm-hmm. And then are you also talking to them about doing lump sum payments or increasing their payments to, right? Like if you've still got a lower interest rate and you can increase your payments, that principal will come down more by the time that they have to renew and their interest rate goes up.
Well, it's funny because on that note, we'll have clients who are like, so I've got an interest rate at, 2% for the next 2.5 years. Should I like withdraw my RSPs and then pay down my mortgage? And they're like, did you like make a higher income this year? Yeah, actually my income went up. I'm like, okay, that's a terrible idea. So let's not make any of these rash decisions. I would say it's hard to say with any one specific person in mind. Everyone's case is different. But for instance, pulling money out of an RSP, probably not a good idea in terms of like, the tax liability that you incur as a result of doing that. And also like depending on what your return rate is of the investments that you may be drawing down. Or, I don't know, you can get a GIC at 5%. So if you're at 2% and you've got money and you've got some money and you could make a lump sum now, right, while it's still at 2%, but you could also just put it into a term or whatever is producing a better yield and wait for the renewal to come up.
Right.
So when the renewal comes up, then make your lump sum pay down. If you can, you're a free agent, you can do whatever you want at that time and then convert to whatever rate would be. So in isolation, we would always want to look at the whole picture. And like, we'll have people who are like, so I've got, $40,000 burning a hole in my pocket. And it's like, well, do you have any other debt? It's like, yeah, I've got this car loan at 9%.
Right.
With payments of $700 a month because the amortization length is shorter than a mortgage.
Yeah.
I'm like, okay, so pay that off and then reattribute that payment to your mortgage. That might be more prudent.
Right.
So looking at the whole picture is where we would typically look at it. If you can't produce a better return rate, for instance, of variable rate mortgage clients, people who have had their mortgage rise over the last 2.5 years, it might make much better sense for them to start making larger contributions towards paying down the mortgage or increasing their payments now because they can't get the same yield in the market as opposed to like the 6%, guaranteed rate that they're going to have to pay on their mortgage.
Right. Okay. Yeah, actually, we've been talking mainly about the fixed, right? If you've got the 2% fixed and stuff. So yeah, the variables are significantly high.
Yeah, proportionately, like over the last several years, where most Canadians have in the past taken fixed terms, through COVID, variable increased dramatically. Interest rates were much lower, payments were fixed at those lower amounts, people qualified for more as well. So a lot of people did go with a variable rate term. So with them, it might make more sense to make those changes. And for some of them, they're also considering maybe converting their existing variable into fixed if they would want to do that now and take advantage of lower fixed interest rates than where their current variable is priced at.
Right. Okay. And actually, just listening on another podcast, there was really good advice where somebody said, before I go and make a big financial decision like this, like, do I put 40 grand down on my mortgage? I talk to two people. So ideally, if this is you and you're in this kind of situation, you're trying to decide, maybe talk to your mortgage broker or call Damon, and then talk to your financial advisor, or talk to somebody who's in the game. Don't talk to your mechanic who's really good at fixing your car, and you should definitely talk to your mechanic about fixing your car, but talk to somebody in the financial world, in the mortgage world specifically, if you're going to ask about your mortgage or about withdrawing from your RSPs.
And probably throw your accountant into the mix as well. Because, so for instance, you may have clients where they're like, well, if I just don't pay my CRA taxes and go onto a payment installment plan, right, I only pay a rate of 10.5%, right? Whereas I'd have to take maybe private lending or whatever it may be. So, but that's non-deductible debt, right? So it may be more prudent to pay that CRA bill as opposed to thinking I'm just going to take it, run it the long run.
Yes, we would generally not suggest people don't pay the CRA because they're like the best collection agency in Canada. And then what are some big mistakes that you're seeing people make? So again, this last couple years has been a lot of just, oh my God, the sky is falling and it's going to continue to fall. That often will make people make rash decisions and do silly things that maybe they shouldn't have if they would have spoken with a professional. Like, what are some things that you see, like just real life examples of, oh my God, I can't believe you did that?
I think so. For instance, with a lot of people who had variable rate mortgages, depending on the institution, take TD, let's pick on TD for instance, they had a mortgage product where the payments didn't fluctuate. So the payments stayed fixed, but interest rates went up. So their amortization length of time continued to increase to a point where it's infinite because actually they're not even paying interest anymore. So if, let's say you're in a position like that where you're not paying anything down, obviously not a good place to be, right? If you're not paying any of the mortgage down. But in order to start paying it down, you have to increase your payments or make lump sums. And so, for instance, the bank were reaching out to clients, and because, of course, this is also a big risk to the banks, right? Having people not paying down their mortgage when that's what they were assumed to do, it's not good for their risking. It's also bad for regulators and in the regulators' eyes. So, like, the banks were, TD in particular, reaching out to everybody to say, you need to do this. When contractually, they're not obligated to. They're not required to. So we'd have clients where, and this is how the banks would typically pose it. They'd be like, okay, so you're no longer paying interest and it's accumulating on your mortgage. TD was saying three different things to their clients. They were saying, well, one, you can make a large lump sum of $200,000 to $300,000 to be able to be back on track with your mortgage, which of course was catching people totally off guard. You hear that, you got to make a 20%, lump sum or 25% lump sum to your mortgage that you don't have to be able to be back on track. Or, well, if you don't have that, you can increase your payments by like $600 per month, or you can convert your mortgage into a fixed term, which will again reamortize your debt. So clients often hearing this would just go, well, yeah, let's just increase the payment, right? That was like a reaction, not knowing that, there's this secret option C that they're not saying to anyone, saying, well, you don't actually have to do anything. You own a $3 million house and you only owe $600,000 on it.
Right.
There's plenty of equity there that if you were given control of whatever you contribute your cash flow to, and maybe you're like, I don't know, on a pension or a fixed income or whatever, it wasn't to increase your payments, right? It would be to pay for other things that are related to your life. So we'd often find clients who had already gone ahead and done this, unaware that there were other options that existed. So this is to say, while your bank might be reaching out to you for things like, in that circumstance, your mortgage payment changes because you had a variable that's gone up. Maybe it's your mortgage renewal coming up. Don't make decisions in isolation. Bring in your other stakeholders. Speak with your mortgage broker who's unbiased to any particular lender, and they can let you know what's available in the rest of the market. Speak with your accountant, speak with your financial advisor, because maybe that cash flow is attributed better elsewhere than to that mortgage.
Yeah. Well, if I'm the bank, the cash flow is always better attributed to me.
Yeah. Yeah. As long as you don't pay too much, because we're also making yield from you. So
right. Yes.
Yeah.
Pay it. Keep paying.
Just enough
don't pay it all the way.
Yeah. Just enough to reduce our risk.
Yeah, but not enough so that you stop paying us interest.
Yeah.
Yeah.
Yeah. So that would be something that we'll often find. Again, the other thing too, and we talked about it earlier, was more to do with people's loyalty to their existing bank.
Right.
Thinking that, well, I got everything there, like why would I? And sometimes that may be because people are like, I just don't want to be bothered with moving all my banking somewhere else, right? So
Yeah.
they want it, they're concerned with, well, if I have my mortgage at RBC, and you're suggesting I can get a better return or a better rate, at Scotia, well, I got to move all my banking. It's so inconvenient. And you don't. Leave it all there. Treat the mortgage as a commodity. Move it over to whatever institution you want it to be at. Keep your banking, your business banking, everything where you like it.
Wow. Yeah. I'm glad you actually just said that out loud, because I would just assume, yeah, of course, you just move your mortgage where you want. But yeah, some people would think that you have to take everything there. But
Yeah.
You don't. You can just move your one thing.
Like, I would agree, and bear in mind, there is an edge to having it all consolidated in one place. I would love to look at my online banking and go, everything is there. I have complete visibility from one sign-in, right? And so there is an edge to that. But you have to be able to weigh whether or not that edge is worth $10,000 in additional interest costs that you're paying with the quote-unquote bank that has your best interest at heart.
Right. Okay. And then switching gears a little bit. So if somebody was investing in the prime time in the last couple of years, and maybe they put a deposit down on a presale that was supposed to complete in 2, 3, or 4 years, that is going to be completing nowish or soon. So when they put this money down, they thought they were going to be able to get a mortgage at a lower interest rate, and then now maybe the penciling the numbers doesn't pencil as sharp.
Right.
Do they have any options? Like, what can somebody in that situation do?
Not a lot. So when you're in the presale, so like if you're thinking about exiting out of the presale, for example,
Or even to take it on, but maybe, say I wanted to buy this condo, I put my $50,000 down 2 years ago, and I thought that I would be totally fine taking on that mortgage and that the rent would cover it, but interest rates have changed. The mortgage is going to be higher than what I thought it was going to be 2 years ago.
Right.
Do they have any options? Is there flexibility there? Or it's just, you gotta close and hopefully make it work.
So with presale, there's a handful of lenders that are willing to extend presale mortgage approvals. And so what that means is that you would approve or get approved at whatever your circumstances were at that time when you put down that $20,000, $30,000 deposit. So, maybe you were employed at that time, great credit, your income was sufficient to qualify, and you qualified at, and typically these rates are about, 0.5%, 0.75% higher than your traditional rates, hedging for kind of an anticipated increase in interest rates in the future. So these options are great to have because, like, I have a client, it's 7 years since they entered into a presale contract in Brentwood. So 7 years ago, I don't know, like I started dating my wife, 7 years ago,
So things changed.
so like I have a baby now. Like, life changes over the course of a long period of time like that. Life changes. So your circumstances could change. Maybe you are no longer employed. You're self-employed, right? Recently self-employed. And even though you're doing much better than you were before in the eyes of a lender, it might be tougher to qualify. So by having those existing pre-sale approvals in place, it's kind of like insurance, protecting you against anything that could happen in the future. Maybe you were able to protect interest rates that at the time, was like 3.75, and you're like, oh, that seems pretty high. It doesn't seem very high now. It seems pretty great. So being able to have something like that in place would have been good in retrospect, right? If we're talking about clients that are coming up for like closure now, the best thing that you could do, start like planning early. Don't just wait for this to come up. And a lot of mortgage brokers or even banks, for instance, will kind of just say, well, we can't really approve anything until we're about 4 months out from completion.
Right.
And so, you might be like a year out. Sure, they can't approve anything, but like, wouldn't you have liked to known that if you claimed a higher income, in 2023, for instance, if you had that control, if you were incorporated, for instance, and you could, increase the T5 or whatever it may have been, that it would allowed you to qualify for the financing you needed because interest rates have risen so much. So again, advance. The earlier that we can get working on something and prepare you for what to expect, the better. So if you can do that and then structuring it in such a way that maybe interest rates now are higher than what you were expecting them to be, and there's anticipation for things to improve. So maybe start looking at shorter term lengths as opposed to taking a 5-year term like, standard at higher rates, with the anticipation of interest rates to potentially decline and for things to look better in terms of optics and cash flow. Maybe look at a shorter term where you bleed a little bit on the earlier side with the expectation for things to improve 2 to 3 years down the road.
Okay. And then in the last couple of years, our levels of government have been fiddling with the real estate market on a weekly basis without even really giving it a chance for what they fiddled with last year to even settle in. Are you seeing any of these government fiddlings having a positive impact on people, or is it just is it working, or is it just causing confusion, or is it actually doing the opposite of what it said it was going to do? What are you seeing? Are there any of these government programs where they've played with real estate and played with mortgage and all these rules where it's actually coming out better for people?
Right. So in retrospect, the fact that they increased the mortgage qualifying rate, or they created the mortgage qualifying rate,
The stress test.
yeah, was a good thing. Okay. Coming out of COVID, interest rates bottoming out as low as 2%, it would have, had people have, let's say, for instance, been qualifying at those mortgage rate thresholds, people who would be coming up for these renewal periods now that are stressing out about what's to expect could have been carrying somewhere up to 30% more debt.
Right.
So in retrospect, as much as I was like, oh my God, people are being cut back, it's, really affecting first-time home buyers' abilities to borrow, that was a good move to protect Canadians against themselves, from having borrowed, significantly more than they could have comfortably afforded prior to 2018 when that rule was implemented. So positive on that end. There's been other kind of more intervening rules that have changed how the banks will now adjudicate their financing. And I'm saying, to your point, they are changing all the time. There's always different modifications that are coming up from now and then. Nothing as significant, I would say, as the B20 rules that came in that adjusted that mortgage qualifying rate. The one problem is that they're not changing the one thing that's actually going to matter to anyone here, which is improving supply.
Right.
So the restriction on supply and the lack of inventory is the significant barrier in all of this. Even though they've done things which have incurred a reduction in market activity by making it tougher for people to qualify, everyone then adjusts and everyone still wants to get in.
Right.
So
still need somewhere to live.
Right. It's not like from 2018 the market's been just soft, because they introduced this new rule. As a matter of fact, completely the opposite. So on one hand, that was a good one. On the other hand, they're not doing anywhere, they've done other implemented what they consider to be benefits for first-time home buyers that go unutilized. Programs that
the first home savings account and things like that.
Well, the first home savings account, that's new, and I'm saying it is beneficial, right? It's nice. It works in tandem with an RSP, so there's some benefits there. It's, we're in the Lower Mainland, and property values are so significantly higher here as opposed to the rest of Canada. So it's tough for the first home savings account to really make a meaningful difference for most people. But it's beneficial. The one in particular I'm thinking of is the I can't remember what it was called. Anyway, they just defunded it now, which was the program where they would provide a loan. The Canadian government would provide a loan and take an interest in your property. So it was an interest-free loan, but you had to pay them their pound of flesh based on the gains of your prospective property, and how difficult it was to qualify for that program. Out of the, let's say, 300 or so clients we might assist over the course of a year, I probably helped 2 people with it in the last 5.
Wow. Okay. Yeah. So good thing they scrapped it.
Yeah, good thing. Kind of a pointless program. Didn't really, help who they intended it to help. Added a lot more confusion. It was just something that I'd end up telling people about, and they'd be like, "Oh, I guess it doesn't fit me," and then be like, "Yep."
Right. And then hearing more and more about specialized lending programs for higher income professionals. So in the insurance world, we have this. There's different types of insurance. If you're like a medical professional or you've got a certain engineering degree or things like that. How does that work as far as mortgages are concerned?
Yeah. So that's been a bit of a new thing. So on the mortgage side, so a lot of the major lenders, major Canadian bank lenders, have instituted new programs where ultimately they're all clamoring for the same type of client. They all want the high income professional, right? The younger the better. And if they're medical professionals, they have specific programs that are specifically available for them. They try and initially attract them with professional credit facilities. So like unsecured credit lines at prime minus 1.5 or whatever, like something that's like at 100K that like really gets them in the door. You'd be stupid to pass up because it's such a benefit in terms of your business, or if you wanted to open a practice or whatever it may be. On the mortgage side, they have specific programs that are for these same types of professionals, more often for like new medical professionals, new veterinarians, new engineers, new people basically that are emerging into these industries where they maybe don't have the income history to demonstrate that, I'm an anesthesiologist. We all make about $700 million a year, but I'm in residency and I'm only making, $80,000, but I still want to be able to buy like a $1.5 million home. I've got 20% to put down, whatever it may be.
Right.
So these programs have been created to allow or account for future prospective income. And so this is another example where one institution may have it, one institution may not. Or one may say you have to put 35% down versus another one that'll allow you to put 20% down. So by kind of playing the field and getting a sense of who is offering what, depending on your particular case, is super important because you could really be leaving money on the table from one institution to the next.
Right. And then are there any other differences in there, or it's just you can qualify for more with less income, or is there like structural differences in those mortgages?
Pricing. So for instance, interest rate will certainly be affected as well, depending on the profession. So there might be better pricing applicable to individual professions. Some institutions really want the doctors. Some institutions really want the engineers or lawyers. There's even banks that specifically target RCMP and Department of National Defense.
Okay.
Yeah. So depending on your profession, and I know that's a bit of an auxiliary, non-corporate related person, but depending on your profession, one may offer something substantially different than the other. So that's something that is probably only come to fruition over the last 3 to 4 years,
right?
Where they have these more, these professional programs where they'll allow you to qualify. But yeah, there's nothing else other than some of them will allow. So for instance, that Department of National Defense RCMP product will waive penalties, for instance, if you decided to break your mortgage.
Oh, wow.
If it was as a result of a job transfer.
Right.
That's the only one structural thing I can think of now.
Yeah.
But otherwise, they're pretty standard regular mortgages. They're just like, instead of using a $90,000, which is what you're currently earning for income in your residency, they'll use like $400,000 as a projected income.
Right. Okay, so you can qualify for much more.
Considerably.
Right. Are there regional differences for this? Like, is it different if you're in Vancouver versus if you're in Edmonton or Winnipeg or something like that? Does that change?
Not to the professional income programs where things may change depending on region. One would be credit unions. So for instance, credit unions are usually specific to one province. Right. So in BC here, we'll have the Coast Capitals or the Van Cities. In Alberta, you'll have the ATBs, and, Ottawa or Ontario, you'll have the Meridians and other different credit unions that are regional or have a regional structure. So they all have different programs themselves. Right. So depending on where you're located, you may, if we're looking at credit unions, for example, they may have something that's applicable to you. As far as what regional differences play a role in your lending when you're with, let's say, a major bank? That comes down more so to how much they're willing to lend you on a specific property price. So for instance, a $3 million house in Vancouver is almost ubiquitous, right? They exist. It's not really like a big outlier, right? A $3 million house in Saskatchewan is different, right? So they are unwilling to, let's say, for instance, lend, like here, you might get 80% financing on a $3 million property. In other more rural markets where it's uncommon to see kind of property values at that scale, or for instance, you don't quite have the same population, they'd probably scale that back to like 65%.
Right. Okay, never thought of that. Okay. And then who do you see kind of winning right now? Like what types of people and what are they doing that are coming out ahead on this with all of kind of the turmoil that's going on and the constantly changing numbers everywhere? Who's doing a really good job as far as, like if it was me, what have I done where it's like, okay, you did all the right things to set yourself up for success?
Right. Okay. So I think people who have been diligent in reducing their debt load on their principal residence, right, non-deductible debt, have been using principal residence as a vehicle or a tool to be able to invest. And that could be borrowing money, using the equity of your property to invest in the market, whatever, something that would be a deductible investment. Or for instance, buying an investment property, right? Being able to target investment property that maybe, for example, I find like in the Lower Mainland, if you could target something that is unimproved, right? Buying a rental condo that you can do some minor improvements to and improve the overall rentability of it and appreciate or help it appreciate in capital value, right? That is, if you've got money ready to go and you're smart about where it goes and you're working with the right partners, and that includes realtors in this case, realtors who have a keen awareness of how that you can create value in certain markets, right? And not just being kind of like focused on a rental condo building or a rental unit in Vancouver,
right,
but be willing to look at outside areas where you can generate either better return rates on rental income or better capital appreciation, or maybe it's the land play, right? Maybe it's buying something that community plan is going to be changing in the next, or you feel like that community plan is going to be changing in the next 10 years. And so if you can target a property, rent it out for the time being, leave it untouched, just kind of do moderating improvements to it, find really good tenants at a low price point to then later hope it becomes part of an assembly. That's the right move on real estate right now.
Okay. You mentioned pulling out equity. How is that looking right now as far as getting HELOCs? Are they handing those out, or those have been restricted? How's interest rates looking on a HELOC?
Yeah. So most lenders are happy to give them to you so long as you can qualify. Right. And qualifying for them is the real struggle. And because of that mortgage qualifying rate, the stress test, it has the stress test based on the rate plus 2%. Mm-hmm. So most lines of credit are priced at around prime plus a half. Yeah. So that's putting it around 7.7%. Okay. You probably get them around prime, depending on, your total net worth, your relationship with the bank. So let's call it 7.2 at best. Add 2% to that, you're now qualifying at 9.2%.
Right.
So qualifying at 9.2%, regardless of your level of income, can be a real challenge for a lot of people, especially if they're already carrying an existing mortgage, right? So it's in tandem with that. So they can be a little bit more tricky to qualify for because of that. But if you can access those, great option. Alternately, if let's say, for instance, as opposed to the line of credit, maybe you're like, I know I need $200,000 right now because I'm going to buy an investment property. You could, as opposed to taking it as a line of credit, take it as a mortgage. So same bank, for instance, let's say you're with RBC, you have your existing mortgage. And this is, for example, a thing called a home line plan. So you have your existing mortgage, you're already just paying it typical whatever. And then you have another $200,000 tier of that mortgage that you're going to be using for investment purposes. That tier could be priced at a lower rate. Overall, you can qualify for more financing because of that lower rate and because it's a mortgage. So there's benefits there. And because it's separate from your original principal mortgage as a separate tier, that is still deductible. So that separate tier, your accountant's going to be so thankful that you set it up that way, because now they're not having to try and figure out, well, how much of this debt is attributed to your principal residence, which is non-deductible, versus the one that you drew out to be able to buy this investment property. So structure is really valuable if you're going to be setting up something like this. If you're going to be pulling out equity, depending on what it is that you're choosing to do with it. Generally, staying with your existing bank can often provide some value, but not always.
Okay.
So first place to start is, what can we get through the bank? And then how does that compare through the rest of the market? Because maybe it makes sense to go elsewhere. Maybe it actually makes sense at this time to break your mortgage, to absorb the penalty, and get better terms on something else that you could get elsewhere.
Okay. And then actually, you just mentioned sticking with your existing bank. So as these mortgages renew, are there situations where you're kind of going to be forced to stick with your existing bank? So again, you qualified for this mortgage 2, 3, 4, 5 years ago, and then now it's going to renew. You said, things happen, life changes. Do some people's options get limited where you then aren't able to go look elsewhere, and you have to stick with your bank and can, just roll that one over?
Absolutely.
Or whatever it's called.
Yeah.
Mortgage
Yeah.
bond.
So that happens a lot. And that's kind of the unfortunate thing about the mortgage stress test, is that if you stay with your existing lender, there's no requalification. So long as you always made your mortgage payments, as long as you haven't defaulted on anything, 99% of the time, they're going to just renew your mortgage. You've been a great client of ours. Here's your renewal. Here's the rates to choose from. Those are often negotiable, again. So, it's worthwhile to do that. And you can just do it as simply as just signing off on a piece of paper. If you were to choose to go anywhere else, right, or you wanted to borrow more money or extend your amortization, like those things that we discussed earlier.
You're changing the terms of
the agreement. Even if you stay with your existing lender, it's going to require you to reapply. So going elsewhere or changing any of the terms requires an application. So if, let's say, for instance, even though you are making maybe slightly more money than you made when you first got this place or when you first got the mortgage, you may no longer qualify.
Right.
Because interest rates have risen and the mortgage qualifying rate exists. So it's important to assess whether or not those options exist. Unfortunately, if you can't qualify, like there's no way of getting around it. It was recently requested by, the institutions related to trying to keep competitiveness and fairness in the mortgage or in the banking industry available. And they were suggesting, can we make some, flexibility on this? Because this is what's happening. People are going to be stuck with their existing lender because they can't renew, and that's anti-competitive. And the banking regulator, who only cares about banking risk, said no, because this will increase the risk of any prospective lender that's going to be taking them on. And it's like, so it's
they should be doing their own underwriting to know whether or not they're going to be able to take on that risk.
Yeah.
But okay, so you might get trapped with your existing lender, and then so if that existing lender sees that you're potentially trapped with them, do they give you some sort of do they give you the best deal right up front, or do they say, well, you're trapped, so you can't really say no to this, and we're going to just jack you as hard as we can?
I don't think any lenders really have an awareness of their leverage. I think it's just the computer says this. Generally, when it comes to your renewal, the computer says this, and again, if you can find something better, let us know, because we'll try and match it.
Right.
So that's often the case. If you were delinquent in payments, they will 1,000% either say no, or here's your new rate, it's 9%. So that's the most important thing. If you could put any money towards anything possible and you can only have a limited amount, make sure it goes to your mortgage.
Right.
Let everything else slide, because even if you miss one mortgage payment, or delay or late on one mortgage payment, you might become untouchable. Like lenders may not even want to renew your mortgage.
Right.
And lenders may not want to take on your mortgage. Private lenders might be willing to do it at 12%.
Right.
Or you might have to be forced into sale.
Yeah, so that's what. So if you can't renew your mortgage, you would have to sell your place.
Correct. Yeah. So that is not something that we often see. That's only applicable generally for when people are, they've really struggled. They haven't been able to make their mortgage payments. So like, if you're a little bit late with a payment, it's not a good thing, but generally you'll get enough calls from the bank to say, hey, you missed this payment. You may have just been like on vacation and maybe it was just automatically deducted from a bank account. You forgot about it. And that is something that can sometimes happen. And there's some, a little bit of forgiveness on that, but not a lot. Not like a credit card where you can just go on and on and on and it still doesn't register as a delinquency. So that would be bad. But yeah, just to kind of go back to what we were discussing before with your mortgage renewal and coming up and being prepared. Let's get prepared. Same thing goes. Like you don't have to wait for your renewal to pop up for us to be able to do anything.
Right.
Let's have that conversation. If you're concerned about your renewal coming up a year in advance, maybe you're incorporated and you have some control over how much you draw down from a personal income standpoint to be able to qualify for better terms. Let's get ahead of it.
Right. Okay. This has been a great conversation, and I could probably keep this going for a while, but we are getting on time. So maybe what we should do is wrap and schedule another one for in a couple months when things change again. But sounds like the big takeaways today is get in contact with somebody as soon as possible if you are either looking to start a mortgage or to renew. Don't wait until the last minute, because then that'll give you more flexibility. It'll also let you know kind of what you're looking at. And if you need to make any changes, especially if you're incorporated and you have that ability to control your income. Sounds like you should probably also talk to somebody who can show you options at different lenders, because like how many lenders do you work with? Probably 30, 40, 50?
There's about 40 different lenders.
40 different lenders, right? And each one will have their 3, 4, 5 kind of mortgages that they do, and that each have their own little term.
Different policies, different rates, different terms, different niches.
So if you add all those up, there's probably hundreds of different types of mortgages that you could get and hundreds of different versions of things. You want to talk to somebody who can know what those are, ideally not show you hundreds, but show you like 2 or 3 that fit your situation. But they're going to show you more than what just your bank is going to show you. What the bank is just going to show you what they offer. And it's usually you either get mortgage A, B, or C, and there's not a massive amount of flexibility in there unless unless you have a tremendous amount of money with them, and then you can negotiate more hard. What if somebody wants to get in touch with you, and what's like, who should get in touch with you? Are they under any sort of obligation to work with you? If they really like their bank, does it still benefit them to call you or to email you?
Yeah, great question. So best way to get a hold of us, you can email myself at damon@wearepilot.ca. I'm sure we'll have a link to...
Yeah, we'll make sure we include it underneath the video wherever you're watching this.
Yeah. So damon@wearepilot.ca. You can actually visit our website as well, wearepilot.ca. So wearepilot.ca. You can reach out to me on my personal line, 604-607-4704 as well. Text, whatever. We're happy to communicate with people, whatever is the right fit for them. If you have, let's say, for instance, you're like, I love dealing with my bank, but I just want to make sure that they're doing the right thing for me. We work with all the banks. So if you wanted to have unbiased third-party support, but would like it to stay with a particular lender, happy to do so, right? And at least keep them honest. So save you the hassle of the back and forth of trying to negotiate with them. We can handle it for you. Keep it all consolidated in one place.
Thanks for listening. Make sure that you like, make sure that you follow, make sure that you share, and push all the buttons all around this video, all around this podcast, so that the robots know that you love it, and that the robots know to send this to more people that are just like you. That's it for today, and we will see you next time.